The market is facing many uncertainties right now. What I would like to do with this video is to see a technique to manage risk in uncertain times. I've been in this business for many, many decades. I wrote 3 books, and I'm totally convinced that the only way you can manage risk is using trends of the business cycle. You have to apply yourself, but once you do, you will see that managing risk is much, much easier. When people talk about the business cycle, they always think about economics. The business cycle is not about economics, it's about business decision making. Let me show you what I mean. At this point, let's start from here. This is when the business is very poor, and business, because of declining interest rates and inflation, decides to start producing more. And of course, as they produce more, there is more employment and wages increase, and more is produced, more people are employed, more money is made, and slowly there is this positive feedback, it's called, that the economy eventually grows and grows what is the long-term average. It's like a runner reaches his pace. But then things are heating up. In other words, business gets excited about the outlook, so they produce even more. And at this point, the economy gets stretched. In other words, the runner is rising too fast. So what you're beginning to see is prices are going up, commodity prices are going up, people keep buying, they borrow more, then you're beginning to see interest rates rising, and of course, as prices increase, you're beginning to see inflation and interest rates even higher, more inflation, more interest rates, more buying. And of course, business gets really excited about how hot is the economy, so they start building a lot more and build and build and build. And sure enough, around this point, consumers are saying, wait a minute, interest rates are high, and the cost of debt now is increasing. So, can I afford all these mortgage payments? Inflation, of course, is eroding purchasing power. So demand starts slowing down. But remember, business doesn't see that. Business still is producing, so inventories are building up. But people, again, once they don't have enough money to spend because of this rising inflation, so they slow their purchases. At this point, at some point, business finally realizes that they have too much inventories, and so they have to cut production. But by cutting production, that means they have to buy less raw material, they have to hire fewer people, the high-paying job in the industrial sector, they have to borrow less. So as this unwind is the opposite of what happened in phase 1 and phase 2, business cycle unwinds, less purchases because of rising inflation, less production because of lower demand, lower interest rates and lower inflation because the economy slows down. And then the economy keeps on slowing down until when? Until this point. This is the point where interest rates are declining so much, inflation is declining so much, commodity prices decline so much that business says, wait a minute, this is the time maybe to start producing and rebuilding the inventories that we cut too much. And the business cycle starts all over again. The point is that commodities and interest rates and inflation rise, commodities, interest rates, and inflation decline on this phase. This is what drives portfolio management and the management of risk. And I will show you what I mean in the next slides. This is the real-time business cycle, and a very effective way of showing where the business direction is to look at the manufacturing employment. Manufacturing is a very important sector of the economy. There is substantial work done that where manufacturing goes, so goes the economy. But this is not the purpose of this video. This is a very simple way to show how the economy strengthens, the economy weakens, manufacturing strengthens, manufacturing weakens. When manufacturing strengthens, you can think of they have to buy raw materials, they have to pay wages, they have to build inventories, they have to borrow money to pay for all these activities. When the economy slows down, of course, they have to do the opposite. They are laying off people, so manufacturing employment slows down, they borrow less, therefore interest rates decline. They don't have to buy so much raw materials, hence raw material prices decline. They don't have to borrow as much, and therefore interest rates decline. So here is where the cyclical stocks do well. This is where the defensive stocks do well, and the cyclicals do poorly. The question is then, what kind of portfolio should one have to manage returns and risk during a full business cycle? Well, you can put it this way. You can have 1/3 of the portfolio in dividend-paying aristocrats. What are they? They are companies that provide returns in yields, for the last at least 25 years. The components of this universe of investment is the ETF Nobel, Nobl. They're conservative companies, they're conservative stocks, they perform well during business slowdown. When the business strengthens, you want to have in the portfolio companies that do well during the upswing in the business cycle, and therefore you have 30% of cyclical or industrial stocks or technology stocks. We'll see what they might be. And then 40% long-term bonds. I've done substantial research. There is substantial evidence that if you have, on average, and that's the tricky word, on average, 40% of long-term bonds, you minimize the volatility of your portfolio. So how do you manage this ideal portfolio during a full business cycle? Let's see. Well, let's assume you start at this point, at the bottom of the business cycle, with your ideal portfolio, and you see that the growth in manufacturing employment starts rising. So what does that tell you? That the economy is strengthening. So that business is going to buy raw materials, that sales are going to grow, that they will borrow more, therefore interest rates are likely going to rise. So that means that profits are going to be stronger because sales are going to be rising faster and faster. So here, what you want to do, you start investing, selling the defensive stocks and increase the exposure to cyclical stocks. So instead of 30% cyclicals, maybe here is going to be 35, here is going to be 40, and you start increasing as the economy strengthens and the growth in manufacturing employment grows. The 40% bonds, obviously you're going to reduce that too, because as interest rates start rising, you don't want to be in bonds, but you always want to have a little bit of everything, but the majority of your investment should probably lean towards the cyclical stocks, technology, for instance, financials, like mining stocks of the type, Caterpillar, energy stock like Exxon. These are that are the kind of investments that will likely to outperform the market. So when you see this turn in manufacturing employment, what are you going to do? So the basic strategy when you see that manufacturing employment is rising faster and faster is to decrease the defensive investments, increase the cyclical stocks and technology stocks, and decrease your exposure to bonds. How much? Well, it depends. But towards the peak of the cycle, you're probably going to be 50, 60, 70% in the stocks, and then the rest in defensive and bonds. So it depends on our appetite for risk. Some people will go more into cyclical stocks, other people less, to maintain a certain balance. For the past 2 years, you have been increasing your cyclical stocks and reducing your defensive and bond portfolio. At this point, you're probably about just maybe 20% in bonds or less, depending on how aggressive you are. Very few defensive stocks like utilities or real estate or staples, and you're mostly in cyclicals, energy, technology, and financial, as an example. At this point, you're beginning to see for 2 months or 3 months that the growth in employment in manufacturing is beginning to taper off, and it's not rising anymore. So you may be considering that is a time, maybe this is a cyclical top, and the growth in the economy is going to slow down. So you may want to start reducing now the exposure to cyclical stocks and increase slightly the exposure in bonds and defensive stocks. And as you see more and more that the trend is taking shape, now you're becoming more confident that the small steps that you took were in the right directions. If not, you stop. But if you see that the steps you're taking were in the right direction, you keep on going the same thing, exactly the opposite of what you did going in the upswing of the business cycle. So here you start increasing bonds and you start defensive stocks, and you keep going, increasing bonds, increasing defensive, reducing cyclicals, until this point where you still don't know if this is a bottom of the business cycle. That's the important thing. No, do not trust what you see, not what you hear on TV or what people say. Right now, at this point, the business cycle is still heading down. Therefore, in my strategy that I suggest is you stay with mostly defensive stocks, bonds, and very little cyclicals, because you might be here, but from here to this point is going to take some time. Then when you see this, then you start doing the switch in strategy. But right now, with this trend going down, staples and bonds are the best strategy, and cyclical stocks, including financials, are not. So what I've been saying is that when the business cycle shows that the economy is slowing down, what you do, you increase defensive and dividend paying stocks. This is the strategy that I follow in my service. I decrease cyclical technology stocks, and I increase bonds. And the strategy that I follow in my service, I get to the point where cyclicals are just a small percentage, and I could go up to 30, 40%, even 50% in bonds if I'm convinced that the economy is really slowing down. But the bottom line is, when the economy slows down, you want to emphasize defensive and bonds and stay away from cyclicals. Yes, they will eventually rebound. That's what you hear on TV and the gurus, but they don't know when. When you see the manufacturing employment turning around, then you will act, but not before that. You stay defensive and always move very, very slowly. The slowdown that we had since 2018 has been no exception. What this chart shows is the outperformance of the 12 sectors or the 11 sectors of the S&P 500 relative to the S&P 500. So the stocks that are here on top are all sectors that have outperformed the stock market, the S&P 500. And guess what? The sectors 1, 2, and 3, and 4 are the so-called defensive sectors. They are utilities, healthcare, this is staples, healthcare, utilities, and real estate. These are classic defensive sectors. This is the technology sector as well that has performed very well during that period. But the bottom line is, during a slowdown since 2018, and we are here now 2000, this is as of February 14, 2020, the best performing sectors have been the defensive sectors because the economy was slowing down. Guess what? Since 2018, bonds, the blue line, has outperformed the S&P 500. So you don't buy bonds for income. Yes, that may be useful, but long-term treasuries have appreciated more, much more than the S&P 500. Again, this is what I've been saying in the previous slides, during a period when the business cycle slows down, bonds and defensive stocks tend to outperform the S&P 500. Not always, but more often than not, this is exactly what is happening. I tried with these slides to show you how to use the business cycles, the information provided by the business cycles, and how to represent it with a very simple economic measure, which is the growth in employment in manufacturing, and use that curve to drive your investment strategy and try to match your investment strategy to what the markets are doing. By doing so, my experience has been that you reduce volatility, especially in the downturn, by using defensive and mostly bonds to offset the volatility of the market. Does this happen all the time? Not always, but it's a very conservative way of managing your portfolio. And besides, you can follow me on the Peter Dack portfolio, which is published every weekend, every Sunday, and also the same concept that you have heard in the slides are also discussed in detail in my 3 books, Profiting in Bull or Bear Markets, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think.